Today we are looking at SoFi, ticker SoFi. The simple question is this: is SoFi becoming a real fintech compounder, or is the market getting too comfortable with credit risk after a strong quarter? The memorable line for this one is real growth, real bank risk. By the end, you will know the fair value range, the buy zone area, and the three numbers that decide whether this setup is improving or breaking. First of all, this is not financial advice. I'm walking through the numbers, valuation, bull case, bear case, and what would change the thesis. If you enjoy stock analysis that separates real opportunities from value traps using numbers and plain English, subscribe to FinanceToGo and tell me which ticker to cover next. For SoFi, the three numbers are member growth, adjusted EBITDA gain, and the adjusted EPS guide. SoFi is trying to be the financial app people use for borrowing, saving, spending, investing, and eventually more of the financial life. That matters because the bull case is not just a loan product. The bull case is that SoFi can acquire a member once, cross-sell more products over time, and use its banking funding base to improve economics. The latest quarter was strong. GAAP net revenue reached about $1.1 billion, adjusted net revenue grew 41%, adjusted EBITDA grew 62% to about $340 million, and SoFi reported another profitable quarter with 12 cents of diluted EPS. Members grew 35% to 14.7 million. Products grew 39% to 22.2 million, and originations hit a record of $12.2 billion. That is the growth part. The watch item is credit. A lender can look fantastic where growth is accelerating, but the quality of that growth shows up over time in charge-offs, funding costs, and book value. The FinanceToGo score comes at around 7.1 out of 10. Growth is the strongest category. Profitability is now much better than it was a few years ago. The weaker categories are valuation, risk, and shareholder returns, because this is still a financial company that has to prove credit discipline. Here is the simple version. The business momentum is real, but the score is not a screaming bargain. The price chart matters because SoFi is not being ignored anymore. Around $15 to $16, the stock has already moved from beaten down fintech pricing toward growth bank pricing. That does not make it bad, it means the next move has to come from proof and not just hope. For valuation, I would use forward adjusted EPS cross-check, a book value cross-check, and a scenario range. Management guided for roughly 60 cents of adjusted EPS in 2026. The market pays a strong growth financial multiple. The stock can justify the mid-teens or better, but if credit risk rises or earnings growth slows, that multiple can compress quickly. My fair value range is about $14 to $18. The cleaner buy zone area is below roughly $12 to $13, unless future quarters prove credit losses are controlled and EPS guidance keeps moving higher. The bull case is that SoFi is no longer just a story stock. It has real members, real products, real deposits, real earnings, and a platform that can cross-sell over time. Bears may be missing that the bank charter and deposits base can create a funding advantage if managed well. If members growth stays strong, product adoption arises, and adjusted EPS compounds from here, SoFi can grow into a higher valuation. The bear case is that fast loan growth can hide risk until the cycle changes. Bulls may be underestimating how much valuation depends on credit staying clean. If charge-offs worsen, deposits get more expensive, technology platform stays inconsistent, or a member growth slows while marketing costs stay high, the thesis weakens fast. The thesis breaker is simple. Credit losses rise while the growth story slows. My FinanceToGo verdict is buy zone candidates. I like the direction of the business, and SoFi is worth researching. But at the current price, I would not call it a strong buy because the stock already assumes a lot of future success. The setup upgrades if member growth stays above 30%, net interest margin holds, charge-offs stay controlled, and the adjusted EPS path moves above the current guide. It downgrades if credit quality breaks or valuation runs ahead of earnings. Comment below, is SoFi a fintech compounder now, or would you wait for cleaner credit proof? And subscribe to FinanceToGo if you want more stock breakdowns that separate exciting stories from numbers that actually hold up. The reasonable lesson is this: fast lender growth is exciting, but credit quality decides whether the growth is durable.